Good morning, everybody. Thank you for joining us on this dreary Monday morning as we discuss being PPP prepared. I am joined by my partner, Erik Daly, who is going to help walk through the various issues presented by the ever-changing landscape presented by the NonNeeds Certification as articulated by the Treasury, and how best to prepare yourself to be in compliance with that certification, as well as the recently released loan forgiveness application. So what we hope to accomplish this morning is walk through the SBA's guidance on the NonNeeds certifications, some of the key questions related to the release of the PPP Loan Forgiveness Application, as well as implications for PPP borrowers with respect to document production and retention, and then taking a strategic long-term view with respect to the PPP. And then finally, we'll close with an overview of Miller Johnson's new PPP compliance and readiness program. Just to run through a quick overview of the Paycheck Protection Program, that program allowed small business loans to be wholly or partially forgiven based on a formula that was primarily set forth to cover the payroll costs and then rent and mortgage interest and utility payments during the PPP program time period, the 8 weeks from the receipt of funds. It was made available to businesses with 500 or fewer employees, and also available to gig economy workers and 501c3 nonprofit organizations. In the original application of the program, there was no articulation of a credit elsewhere testing, and that's going to be part of what we discussed today. Just to give you, a brief discussion of the evolving guidance of the NonNeeds certification, the CARES Act was rolled out on March 27th. There was no specific articulation of a quote-unquote need certification in conjunction with that application. In fact, on March 31st, loan applicants were encouraged to apply as quickly as they could because there was a cap on funding. All small businesses were designated as eligible. And again, certification of need was not even mentioned. And April 3rd, in the frequently asked questions sheet, there was a question that said, do I need to first look for other funds before applying to this program? The answer was no from the SBA. And then for the first time on April 23rd, FAQ number 31 required borrowers to take into account their current business activity and their ability to access other sources of liquidity not significantly detrimental to its operations. And this is the first time this NonNeeds certification appears. No one reading the original statute could have guessed that this additional requirement applied when they made their certifications a week before this new guidance. And then the SBA, simply stated that, hey, if you return the proceeds by May 7th, we'll consider your application to be made in good faith. And then came FAQ number 39, where the SBA stated that they will be reviewing all loans in excess of $2 million following the submission of the borrower's loan forgiveness application. So that gives you kind of a backdrop of the evolution of this NonNeeds certification. And I'm going to turn it over to Erik Daly to walk through some of the specifics related to both the NonNeeds certification and then discuss the recently released forgiveness application.
Yeah, thank you, Jeff. I appreciate it. So picking up where the prior chart left off, and we left off last week when we reviewed a similar flow chart. The SBA extended that safe harbor deadline for returning PPP loans to qualify for the good faith exemption to May 14th. And then the day before that, on May 13th, the SBA finally published guidance that they had promised about the evaluation of the NEED certifications from borrowers. And in conjunction with that, on the same day, it further extended the safe harbor deadline for returning loans to today, May 18th. The approach that the SBA took in the guidance was basically to give a safe harbor on this NEED certification only, not across the board, but on the safe harbor for the NEED certification only to really 99% of borrowers, if you look at it by number of loans. So any loan below $2 million in original principal amount, they said we're not going to look at these criteria in evaluating your NEED certification. We think there's a sufficient backdrop here to say you probably did need the loan if you applied and your loan was less than $2 million. But that left in place meaningful uncertainty for those borrowers who had loans greater than $2 million. Let's skip ahead to the next slide. So just to go a little bit further beneath the surface on that guidance that came out last week, for measuring the loan size against that $2 million threshold to qualify for this safe harbor, borrowers need to include the original principal amount of PPP loans obtained by their affiliates as well. So if you have multiple entities under common ownership or common control, just something to be aware of if you're thinking you may be able to rely on that $2 million threshold safe harbor. The SBA also did state that for borrowers who don't qualify for that safe harbor, they still may be able to make their NEED certification in good faith based on their individual circumstances and in light of the language of the certification and SBA guidance. So that didn't answer many of the questions that were open after some of the back and forth that Jeff went through earlier in terms of economic uncertainty and sources of liquidity. But it did leave the door open that larger borrowers could still make that certification in good faith. Let's proceed to the next slide, please. So for those borrowers who don't qualify for that below $2 million threshold, the SBA said that basically if they determine in the course of their review, and they said they're going to review all loans above $2 million, if they determine during the course of their review that the borrower did not have a sufficient or adequate basis for their NEED certification, then the SBA would seek repayment of the outstanding PPP loan balance. And if the borrower then goes ahead and repays the loan, SBA said that they would not pursue administrative enforcement or referrals to other agencies based on that NEED certification issue. Didn't address at all whether there would be any kind of appeal process for the SBA's determination or how that might work, if at all. So that's still a significant open issue for larger borrowers. And I think it's also helpful to remember that while this mechanism for returning funds after the fact, should the SBA determine you are ineligible based on NEED certification, that's helpful to avoid administrative enforcement or possible referrals. If there are facts that are otherwise not helpful for a borrower's certification being made in good faith, this isn't an across-the-board amnesty for those larger borrowers. It's really just specific to that NEED certification. So, for example, the SBA or other agencies could potentially pursue non-administrative enforcement, such as criminal penalties or similar relief. Next slide, please. And kind of taking a big picture view of this, the guidance is definitely welcome news for borrowers with loans below that $2 million principal amount to qualify for the safe harbor, but it definitely will increase scrutiny on those borrowers that are ineligible for the safe harbor who have the loans above $2 million. And in explaining the creation of the safe harbor for those smaller loans, SBA and Treasury specifically said that it would allow them to direct their audit resources to focus on reviews of larger loans. And we've emphasized this language here, where they believe that the compliance effort may yield higher returns. So essentially, the SBA is going to focus its audit and enforcement resources on a very small subset of overall PPP borrowers, although accounting for approximately 1% of the total number of borrowers, they do reserve the right to review any loan. So again, it's not an across-the-board exemption from review for smaller borrowers. But the guidance does definitely suggest that the SBA is going to focus more on the larger loans above $2 million, which account for approximately 24% of the total loan principal originated so far. And again, I mentioned some of this already, but there's still some uncertainty for some of the larger borrowers. The guidance really did not address, for example, what types or amounts of available alternative sources of capital or liquidity would be considered relevant to the after-the-fact determination that a loan request was unnecessary. And it also did not address, kind of what types of negative economic trends or business activity or leading indicators would sufficiently justify or support the NonNeeds certification. So those issues definitely remain open, and in light of that, it's for all borrowers, it's still important to create a thoughtful contemporaneous record in support of NonNeeds certifications and other eligibility issues, but especially so for the larger borrowers. Next slide, please. Okay. So to change gears a little bit, that prior discussion was really specific to the guidance that was provided for the NonNeeds certification issue. On Friday, late in the day, the SBA and Treasury released the PPP Loan Forgiveness Application. So there's an application at the outset of participation in the program to receive a loan, and now we have the application for sort of the back-end forgiveness request. And in tandem to releasing that form, the SBA and Treasury also announced that they would be issuing yet more guidance and rules and regulations about forgiveness-related topics. So I think this application gives us a kind of a glimpse and some significant glimpses into how this will work, but we're still waiting some further information, I'm sure, about how this will work. The application form does, in welcome news to borrowers, provide a certain amount of new flexibility to plan and manage toward maximum loan forgiveness. But on the other end of the kind of evaluation of the application from the borrower perspective, it does impose significant documentation submission and retention requirements, which we'll get to later. Next slide, please. So we won't go into a complete, very detailed or technical discussion of the application form, which is about 11 pages long, and it looks a lot like and feels a lot like a tax form you would work through if you were preparing something to support your income tax filings, for example. But we did want to hit on some of the major themes and takeaways from the new application that was released. So for payroll schedules, the form does account for the fact that payroll dates for borrowers were never really likely to align with their 8-week forgiveness periods. And so the application form gives borrowers flexibility to ensure that they receive 8 weeks or 56 days worth of payroll relief. And basically, it either allows borrowers to shift that 8 weeks for payroll purposes to align with their payroll dates, or to leave their 8-week period in place and then pick up payments to employees that were made after the 8-week period, but which relate to work performed during the 8-week period. So there are, I'm sure, be questions about how that gets implemented, but there's definitely additional flexibility there, which should kind of mitigate the need for some borrowers to change payroll periods or have short stub period payrolls, things like that. And the same is generally true for mortgage interest, rent, and utility payments. There was a recognition that those payments could be incurred during the 8-week period, but may not be paid until a regular billing date after the covered period. So, if May is included in your 8-week period, but for example, your rent on a building for May is not due until sometime in late June after your 8-week period, and that's a regular payment date. You don't need to necessarily accelerate that payment to qualify for forgiveness. So there's some flexibility on both of these fronts provided. Next slide, please. Another important bit of information we got, which was a significant open question, was how full-time equivalent employee calculations would work. I think from discussing this with many clients and others and other advisors, there was an expectation that this would be based on a 30-hour work week standard to align with some other federal legislation that tied to full-time employment concepts. But the application form uses a 40-hour work week. It does allow for fractional employees to count toward the total calculation. So as an example, somebody who worked 20 hours a week would count as half an FTE, and you could include that in your measurements. And that goes down to you would be able to round it to the 10th decimal point. So somebody who worked 30 hours a week, I guess, would count for, I'm assuming you would round up here, but 0.75, so you'd 0.8 FTEs. So that, while the number of hours is higher than I think people expected, there's maybe more flexibility to count fractional FTEs than some expected. In any case, nobody can count for more than one FTE, so somebody who works 60 hours a week is still only counting as one full-time equivalent employee. Next slide, please. A couple other points. For borrowers who are familiar with this concept that you can rehire employees by June 30th and reinstate compensation that had previously been reduced by more than 25% by June 30th. There was some question around whether, and I think there probably remains some question around this, but whether there's any kind of tail obligation to continue to employ individuals rehired by that date or to maintain compensation levels beyond that June 30th date. The application form itself did not impose any requirements like that, and really just looked at kind of the June 30th date as a snapshot in time for purposes of determining if the safe harbor is available for rehiring and putting compensation levels back to February 15th levels. So that I think is good for borrowers just trying to plan toward that June 30th date. However, the application does seem to indicate that employers must hire all the way back up to February 15th levels to qualify for this safe harbor. So it seems like it's an all or nothing eligibility for the ability to avoid reduction in loan forgiveness based on qualifying for this June 30th safe harbor. So I like to think about it as no partial credit for kind of partial rehiring for purposes of the June 30th date. And then on employee reductions, there was more helpful information here for borrowers where employees terminated for cause would not count against a borrower's FTE reduction calculations, and employees who turned down written rehire offers or who voluntarily resigned or requested and received a reduction in working hours, none of those situations would count against an employer's FTE employment levels. Next slide, please. So most of that is generally good news for borrowers so far, additional flexibility, and some situations where employment levels FTE levels may have declined for reasons outside of the employer's control. On the other hand, the application does require additional certifications focused on forgiveness and the accuracy and veracity of the information provided with the application for forgiveness. And just as with the original PPP loan application, if the certifications are falsely made, they create the potential for civil or criminal penalties. The application also stated that eligibility for loan forgiveness would be determined based on SBA rules and guidance issued through the date of the forgiveness application. So that suggests that the SBA may issue, some of this further guidance that comes out. It'll be evolving and kind of preserves the ability for the SBA to apply those upcoming rules and guidance to a forgiveness request, whatever's out there at the time somebody applies for forgiveness, rather than say what information was available at the time they applied for their loan. So it does create this, continue to kind of perpetuate this uncertainty around which SBA guidance will or will not apply to any particular borrower's situation. Next slide, please. And then, very significantly, in my view anyway, there are expensive documentation submission and retention requirements, both for the initial submission of the loan forgiveness application and ongoing record retention obligations. For the record retention obligation, essentially, borrower has to keep their entire support file for the PPP, including specifically with respect to the NonNeeds certification, available for at least 6 years following loan repayment or forgiveness for potential review. And the SBA further reserves the right to request other information that's not specifically called out in the application form. And if it's not provided by the borrower, SBA says they may determine that the borrower is ineligible for the PPP or decline loan forgiveness on the basis of information not being provided. So this is, definitely will not go through this in detail, but this is a snapshot from the application of all the information that each borrower must submit with its loan forgiveness application. And as you can see, it breaks down across the kind of major categories of relevant information here. So payroll costs, non-payroll costs, and then full-time equivalent employees, since that factors into the overall amount of loan forgiveness. So this, it's helpful in the sense that it gives them more of a roadmap to borrowers of what information is going to be relevant and that they should track, but it's very detailed and granular and extensive. Next slide, please. And then this is a snapshot from the application about additional documentation that does not need to be submitted with the loan forgiveness request, but does need to be maintained for 6 years after the loan is forgiven or fully repaid. And basically, as I said before, it's really all records relating to the borrower's PPP loan, and then specifically called out there is the NonNeeds certification, the necessity of the loan request, and eligibility considerations. So that's a long-term retention requirement. So in kind of a big picture summary of recent developments, just taking a step back, SBA and Treasury have, at least in part, responded to concerns raised by PPP borrowers and their advisors about this NNEeds certification issue and uncertainties. Certainly for the loans below $2 million, that's the case. There's definitely still uncertainty for those above $2 million. However, the statements about enforcement priorities and the documentation, submission, and retention requirements really do strongly suggest that their SBA, Treasury, other enforcement bodies are going to reserve the right here to scrutinize forgiveness applications and really expect borrowers to be compliance and audit ready. With that, I'm going to turn it back to Jeff to talk a little bit about our compliance readiness program.
Yeah, thanks, Erik. And, based on largely what Erik has been talking about with respect to, the ever-changing guidance regarding the NNEeds certification, the document retention and gathering requirements to support loan forgiveness, and the integrity of that forgiveness application, along with, obviously, the importance for borrowers to maximize the loan forgiveness under the program. Miller Johnson has put together a PPP compliance readiness offering, and it's really an interdisciplinary approach between our corporate lawyers and our litigators. We have a team of 14 lawyers who have developed this program, have researched tirelessly to create kind of template guidance in some issues, but really respond to clients' needs to ensure that they are gathering the correct records, performance data, et cetera, to make certain that that need application was made in good faith at the time they made the application, even though that guidance came down weeks after those applications were made. While there are significant questions about the government's ability to retroactively enforce those guidelines, what the program is designed to do is, to really review the process, help create a process maybe that didn't even formally exist at the time the application was made, to create an audit readiness or preparedness plan, and to advise on best practices with respect to these evolving rules and guidelines. And, we feel that because the stakes are so high, in getting this wrong, we tried to really come out with a value proposition that made this kind of ounce of prevention worth the proverbial pound of cure, something that was easy for clients to kind of absorb from a cost standpoint up front, but really gave a lot of, kind of back end protection with respect to the government's enforcement of the program, and having clients proactively prepared for any resulting inquiry from the government related to the program. So if you have any questions regarding the program, this is a screenshot of the little marketing piece. You can contact me directly. My contact information is on, as well as Max Barnes or Erik as well. And so, Erik, I think we've got a few questions, or at least one question. I'm going to try to open up here. Can you see it?
Sure. I did. I typed out answers to a couple of questions.
Okay.
I'll read them back just for the benefit of the group. The first one, there's some talk of additional SBA clarification info being published later this week. What have we heard on that front? Yes, we're expecting further information from SBA and Treasury on forgiveness-related guidance. They've signaled that. But in parallel, there's discussion about Congress making legislative changes to the program to provide more flexibility on the forgiveness front. So, that would obviously be the ideal approach, since it wouldn't be a further exercise or purported exercise of rulemaking by the SBA, and would actually be a law. being changed. So I think there will be a little bit of Treasury and SBA possibly following the lead of kind of where things are headed directionally in Congress on those changes. The other question was, if a person has a reduction of 30% of their wages, thus they are below a full-time equivalent employee, then should you exclude one reduction or both? You would be dinged twice for one person. So the FTE full-time equivalent employee calculations based on this application are really just on hours. So you're going to look just at hours and not necessarily wages when calculating the FTE level. So in that example, if the person who had a 30% reduction in wages was a salaried worker, say, and they were still working 40 hours a week, then they would still count as one full-time equivalent employee, and you would just have to deal with that 30% reduction in compensation on its own. If it's an hourly person, the way the application form works is, I think you get to the same result. It's somewhat complicated because the form requires you to basically look at sort of average hourly wage over the different relevant periods. So you're still ultimately going to be isolating hours worked and compensation levels. So I don't think there would be a double ding in that situation, if you will. But we'll see if there's further guidance on that point. And then there was a follow-up question about that in relation to hourly employees. And I think the way that the application form is going to work for hourly employees, that it'll, I believe, work out the same way, but we may need further guidance on that point. And then, is there any clarity on self-insured health plans that came out? There's not any clarity, in my mind anyway, based on the application form itself, as it relates to self-insured healthcare plans. Nothing in the application form addressed that specifically. And then there's another question here. What if you have a weekly payroll for hourly employees and biweekly for salaried employees? If when the loan was issued, the company had more individuals on the biweekly period, could the company elect the biweekly period date if it is out further, as that would allow more time to get hourly employees back in place? If you have different payroll, so the application form only envisions that there would be one cadence to your payroll cycle, so it doesn't envision that there could be different payroll cycles for different types of employees. So it's unclear, how one would check the box on that particular issue if you had both. But there is the ability to effectively move your 8-week period out a little bit if you want to choose a payroll period that started. Basically, you could start your 8-week period running from the first payroll period date within that 8-week period, and that gets to basically buy you a little bit more time to pay employees and qualify for forgiveness. So I think there is some flexibility there. Is there any clarity on funding for pension plans? Any pension payments due during the 8-week period forgivable? There's really, the overall theme of the application is that, again, providing additional flexibility so that it could cover amounts paid or incurred in most cases rather than paid and incurred. So in general, I think there's going to be more flexibility on those types of issues, but there's no real specific clarity on, whether you could, for example, make large pension plan payments, that are outsized relative to the 8-week period in comparison to kind of your ordinary course of business. So there's no specific guidance on that issue, but I do think the overall theme of the application does provide more flexibility for situations where at least your ordinary course payments may not sort of neatly align with the 8-week covered period. There's another question. How is the February 15th, 2020 full-time equivalent employee established? Is that one day's calculation of FTEs or for some longer period leading up to 2/15/2020? I believe, if I remember correctly from the application, it's the full-time equivalent employee levels in effect for the payroll period that includes February 15th. So it depends on that entire payroll period that includes the February 15th date, is my recollection from reading through the application form over the weekend. How do temporary employees get figured into full-time equivalent employee calculations? That's another question. The full-time equivalent employee calculation is done based on, basically you look at, during any relevant period, you look at the per payroll period average. So you look at every payroll period and then you average them all together essentially for calculating full-time equivalent employees. So temporary employees could, factor into those payroll periods for which they're, actually employees to the extent that they're working hours, and then you would average, kind of further average together the different payroll periods from there. So you would get some credit for temporary employees in those situations, I think. I think those were all the questions we had. Jeff, anything else that you'd like to cover?
I think that covers it. Thank you, Erik. Thank you, everyone, for attending. Hopefully, you found this informative and helpful, and have a great rest of your week.
Thank you.
Thank you.